video, we're going to learn more about Islamic finance. So, what is Islamic finance? How does Islamic finance work? What is the concept of Islamic finance? Is what we are going to cover in this particular topic. So, as you already know, okay, Islamic finance is completely different from the conventional finance because for the conventional finance, you use the normal laws, conventional laws, and regulation. But for Islamic finance, okay, it is compliant with not conventional laws but the Sharia law. So you must remember that, or you must know that over the years, Islamic finance has been undergoing a very high growth period. So as you know, there are actually an increasing number in banks that are compliant to Sharia law, and they offers products and services that is in line with the Sharia law. Okay, so the reason why we use the term conventional finance is to distinguish between a bank where it operates in a normal financial terms, and when we use the Sharia compliant or Islamic finance, okay, it means that they are compliant with Sharia law and their principles are based on Islamic principles. So, if you understand Islamic finance, or if you want to understand Islamic finance, the first thing besides, okay, them being adhering to Sharia law that you need to know is that they are based, the finance transactions in an Islamic finance is based on the concept of sharing risk and rewards between the investor and the user of funds. Okay, so you also need to remember that when it comes to Islamic finance, okay, you are not allowed, it is forbidden to charge interest, okay, according to the Sharia law. So that is why I said previously that Islamic finance transactions are actually based on the concept of sharing risk and rewards. So if you follow the ethics of the Sharia law, okay, you must remember that making money with money is something that is considered as an immoral activity, and wealth should be generated via trade-based investments. So, as a result of that, they ensure that all their transactions are based on sharing of risk and rewards. So it is completely different with the conventional banks because the conventional banks, they aim to make profit, okay, by accepting money deposit, okay, in return of payment of interest. That means they pay you interest, okay, to encourage you to invest your money in the company. And when they lend out money, that means when they give you cash, when they give you capital, when they give you the source of finance, on the other hand, they require a return in terms of payment of interest. And normally these conventional banks, they will set the interest in such a way where when you make an interest payment, you will pay more interest, and when you receive interest, the amount of interest that you receive is much lesser than expected, right? Whereas on the other hand, Islamic finance strictly prohibits the use of interest, okay, and it is prohibited under the Sharia law. So when it comes to interest, okay, it is, the name of interest is actually riba, okay, in terms of Islamic finance, right? So riba is unacceptable, okay, in the laws of Islamic finance. So it cannot be accepted. So there are three perspectives of riba, okay, that is unacceptable. Okay, so there are 3 points of view, 3 perspectives. Number one, the borrower. number two, the lender, and for the economy. Okay, as for the borrower, why is it that riba is considered as unacceptable? Because it creates an a situation where it is unfair for the borrower when the enterprise or the company or the financial institution is making a profit, okay, which is less than the interest payment, all right, and this will impact their profit and turns it into a loss. That means when you borrow money, you need to pay interest. So the consideration that Islamic finance takes is that when you borrow the money and you need to pay interest, but the amount of profit that you generate from the borrowing is not enough to pay the interest. This means that you are unable to make the payment. So let me just illustrate, okay, in the point of view as a borrower. So let's say you have a bank, okay. This bank lends money to your company. So basically company A is borrowing. So the funds are going up. So as a result of that, your company now needs to pay interest, right? So the reason why you borrow is you want to invest in a project, okay, and you will earn profit. The concept of Islamic finance does not allow interest payment because, let's say, the interest, I'm going to put values so that it's easier to compare. Let's say the profit that you earn here is $25,000, right? But the interest that you need to pay on the borrowing is $32,000. I'm just randomly putting in figures, okay? So you can see from here that the profit that you earn is much lesser than the interest payment that you make. And as a result of that, you actually make a net loss, all right? Your net loss is 32.7, is it? Minus 25 is, yes, 7,000, all right? So this is your net loss. So they deem it as unfair to the company, to the borrower, because interest may exceed the profit that you earn, right? So that's why it's unfair. That's why it is prohibited. Now, for the perspective of a lender, okay, it's unfair in an event where there is high inflation and the returns that you get is likely below the rate of inflation. Let's say you receive an interest of 2%, okay, you pay them 2% and your inflation rate is 2.5%. So actually the inflation rate is much higher than the interest that you are paying the bank. So it is unfair for the lender in an event where there is a high inflation rate. And the next one is in the point of view of the economy, all right? So why is it that it is unfair in the point of view of the economy? Why is it not allowed in point of view of the economy? The reason why it's not allowed is because when there is interest or riba, it can lead to inefficient allocation of available resource to the economy. That means capital may be directed to the borrower because you want to receive higher interest, and therefore it will affect the capital, as in you will not use it for the most effective manner. Instead of using it to invest in what you call it, in the government will invest in investments that will generate benefits to the public at large, all right? Instead of investing in, example, infrastructure, yes, that's the word, investment in infrastructure, you are focusing on giving out money to the borrower to receive a higher interest. So in that sense, you are not actually using your resources, you are not allocating it appropriately, all right? And you're not allocating it as efficiently as you are able to. So that is from the point of view of the economy. So under the concept of Islamic finance, you need to understand that, okay, there are few forms of Islamic finance contracts, okay. But guys, before I proceed to that, let's just quickly write about the concept here of Islamic finance. So when you talk about Islamic finance, it is based on Sharia law, okay, or you can say it is Sharia law compliant. Compliant, okay. So the concept of Islamic finance, as mentioned previously, the Islamic finance transactions are based on sharing of risk and rewards. Okay, hold on. Risk and rewards. All right. So the next thing, okay, that you need to know is that interest or riba, which is another word for interest, is prohibited. Okay. Or you can say forbidden. Normally I call it forbidden. Okay. So why? Okay. The three perspectives that they are unacceptable is from the borrower, investor, and the economy. All right. Okay, now let's move to the next part, which is your Islamic finance contracts. Okay, so what are the types of contracts that we have in Islamic finance? We have mudarabah, you have musharaka, you have murabaha, ijara, and sukuk. All right, so you must know what these individual transaction means. So a mudarabah is similar to a partnership contract. A musharaka is similar to an equity where your profit and losses are shared. All right. Murabaha is a form of credit, okay, trade credit. Ijara is a form of lease, and sukuk is something that is similar to a bond. So unlike conventional banking, right, Islamic finance actually requires an active role, okay, for the use of the asset by the fund provider. Okay, that means if you provide funds to them, you will require the person who borrow the funds to be actively involved in the management or the payment of the assets, okay? And you are also ensuring that risk and rewards are shared. So let's look at the details of your contracts, mudarabah, musharaka, and so on. All right. What are they? Okay. How do they work? Okay, when you talk about mudarabah, okay, what is mudarabah? How does mudarabah work? All right. So mudarabah is actually uh, just now what did I say? Okay, a partnership. Mudarabah is actually a partnership contract. Okay, so when we talk about a partnership contract, what does it mean? Okay. Sorry guys, I think there's something wrong with my there's something wrong with the files here. Okay. 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 So as mentioned, okay, mudarabah is actually a partnership transaction where one person contributes capital while the other person will contribute their skills and expertise. All right. So you must remember that in a mudarabah arrangement, the contributor of the capital, that is the person who provides or contributes the capital to the partnership agreement, will have no right, okay, to interfere in the day-to-day operation of the business. That means they cannot interfere in what is happening in the operations of the organization. All right, because one of the person, all right, is responsible to run the organization or the business, while the other, you are only providing capital. Therefore, the investor, the person who contributes the capital, will have to rely to a large extent on the person who contributes their skills and expertise, and they also need to rely on this person, right, to manage the organization and also to ensure the company or the business is able to generate profit. So mudarabah transaction, okay, are normally or particularly suited for private equity investments, right? So if I would like to illustrate it to you, let's say there is so um, the contracts, okay, so the many types of finance, Islamic finance contracts. Right, so the first one, mudarabah. Okay, so when it comes to mudarabah, it's similar to an partnership where one person provides capital and the other provides the know-how. When it comes to know-how, it means skills and expertise, right? So the skills and expertise to run the organization. So as a result of that, you must remember that the person providing capital should not interfere in operations, right? So you are not allowed to interfere in the operations. So when it comes to capital injection, the investor or the person will provide 100%. The skills and expertise would be provided or contributed by the other partner. All right. The profit and loss on the other hand. Okay, when there is profits, the profit would be shared between the partners according to the profit sharing ratio. To the profit sharing ratio. Okay, while if there are any losses in your organization, the losses will be attributable to the capital provider only. All right. Now, so basically, in a mudaraba contract, all right, you as a capital provider, you need to rely heavily on your other partner to generate profits for your organization. So that is a mudaraba. The next one, musharaka. Okay, so how is musharaka different from mudaraba? So musharaka is also a form of partnership where it is more suitable for specific business ventures or projects, and you need to ensure that there are at least two parties. Okay, it is also normally widely used in equity financing. So how is this different from your mudaraba? Okay, so this is more similar to a venture capital agreement where all the partners, okay, will provide capital. At the same time, they will provide expertise. And in this musharaka arrangement, the profits are shared according to the profit sharing ratio, whilst the losses are shared in accordance with the capital contribution of the partner. Right? So you must remember it is similar. The only difference is, okay, let me see whether I can type, because type may look much better. Okay, number 2, musharaka. Okay, so musharaka is similar to venture capital arrangement. Okay, so what happens in this venture capital is all partners provides capital and know-how. When I say know-how again, it means expertise and experience. All right. Next, profits are shared according to the profit sharing ratio, while losses are shared according to the capital contribution. Okay. Now, so that is a musharaka. The next one, a murabaha. Okay, what is a murabaha? A murabaha is similar to a trade credit, all right, where there is it is considered as a deferred payment, okay, or an installment, okay, which is used mainly for the purchase of goods, all right, for immediate delivery. So what happens is the seller of the asset will deliver the goods immediately, and the buyer will pay for the goods at a later date, right? um So, as part of the contract, okay, the price of the goods, the markup, the delivery date, and the payment date are pre-agreed. That means they will agree upon the price, the markup, that means the amount of additional profit that they will earn, um, the delivery date, and also the payment date. So what happens is that, okay, the sale of goods is immediate, it will be made immediately, and the payment will only be received in future. So how is this in line with the concept of Islamic finance? It is in line because the buyer, they will have the full knowledge on the price and the quality of the goods that they buy, and also they will be aware exactly on how much the markup they will be paying for, so they do not deceive the buyer in any way. All right, so when it comes to the context of trading, the advantage to the buyer is that they can use the goods that they purchase to generate a profit in their business, and subsequently, once you have generated the profit from the asset, all right, you will be able to repay the seller at a later date. All right, so that is the concept of musha sorry murabaha. Okay, murabaha. It's deferred payment made today. Okay. So guys, there are so many things here to write. Okay. Contract, buyer and seller, where few details are agreed upon. Example, price of goods, the markup, delivery and payment date. Okay. Next is a line. Okay guys, this one you can just write it down. It's aligned to the concept of Islamic finance, because the buyer is aware of the exact amount of markup, and they can use that asset to first generate profit for their business and then make a payment at a later date. All right, so next one, ijara. So ijara is similar to a lease agreement. So what happens is, as per the Islamic finance or the Islamic law, the lessor will remain as the owner of the asset, and they are the one who will incur the risk of the ownership rather than transferring it to the lessee. As such, the lessor, because you are the owner, the legal owner of the asset, you will need to take responsibility for the maintenance and the insurance cost, and you will not transfer it to the lessee. The lessee, on the other hand, because you are using the asset on a day-to-day basis, you will take advantage of the day-to-day maintenance of the asset and the wear and tear and any damages whatsoever that arises. So in an event, okay, of a total loss of the asset, the lessee will not be obliged to make payment, okay, of rentals in the future. So I think this is quite simple and straightforward. Number 3, Ijara. Number 4, actually, Ijara. Okay, this is a lease agreement where the lessor remains the legal owner asset and takes care of the they take care of the major maintenance and insurance of the asset, while the lessee takes care of the routine transactions and the day, maybe routine maintenance, okay, and the wear and tear. So in an event where there is total loss, you will not be required to make the payment. Okay. Now the final one is a sukuk, where the sukuk is actually similar to a bond in conventional finance. How is it different when it comes to sukuk? How is it different? It is different because in a sukuk arrangement, there will be an underlying tangible asset that the sukuk holder will share the risk and rewards. Therefore, you will be paying for the asset repayment while having equity in the asset. All right, so you cannot pay interest, right? All right, the company cannot pay you interest. So instead of paying you interest, they will link it to an underlying asset where the sukuk holder will share the risk and rewards, and the sukuk will have a property of equity as well as debt finance. So with that, guys, that is the end of the whole topic of sources of finance. Islamic finance has recently been asked by examiner, more frequently asked than what he used to in the past. So I would always recommend you guys to read and understand the concept very, very carefully, because you may need to talk about this in the future. Okay, so with that, we end here with chapter 12. The next video will be chapter 13 on dividend policy of an organization. Okay.